Hello everyone, welcome back. I am Nicole Payne, CMA, and as always, I'm here to drop some accounting truth bombs. Today's video is part 2 of a 4-part mini-series about financial reports. If you haven't had a chance, go back and watch part 1. It's the basics of reading financial reports. Today we're going to do a deep dive into reading the profit and loss statement. So without further ado, I'm going to share my screen with you. And you'll see me looking off screen over here as I'm looking at the screen that's off camera. No fears, have no fear. This is Craig's Design and Landscaping Services. It's actually a sample company. It is not any one of our clients. I would never, ever, ever share client data. But this company is a sample that QuickBooks provides so that people can play around in QuickBooks Online, become familiar, and do things without actually affecting their company file so that they don't mess up their own books. Trust me, it's happened enough times that we're very grateful that QuickBooks provides this sample company for people to learn and figure out how things work. Anyway, we're going to jump right in. This is your left menu, and right here in the left menu, we have the report section. We're going to go there. And now that I'm in there, I'm going to hide that menu so that you have more screen to see. You can actually see more details. You'll see here in the report section that there are a long list of reports that you can run through QuickBooks. Most of them are not going to be very useful to our everyday average client or company owner, but you might find some in here that are more useful to you than others. Those ones that you find the most useful, you can go ahead and put a star next to them, and then they show up here at the very top under your favorites. So as you can see, there are a few in here. We're going to jump into the profit and loss. QuickBooks tries to be really smart, and it tries to do things to figure out how you use it. And so based on your usage, it tries to default what you're going to look at next. In this particular case, it's reporting on year to date. You have several options for your reporting period. Because again, from the basics of financials, your profit and loss is over a specific period of time. You're looking at a snapshot, a summary of what's happened in that period of time. So your period can change. QuickBooks has a lot of pre-selected periods that you can choose from, or you can just come over here. It's really great. You can just type in the specific dates that you want. So we're going to look at January through June, and that'll give us a snapshot of the first 6 months of this year. We're going to leave the rest of these settings alone for now. We'll talk about a little bit more about them later in the video. So I'm going to hit Run Report, and as you can see, this is our profit and loss statement. It tells you here at the top, in case you forget what company you work for, it tells you what company this is. It gives you the profit and loss statement, or it tells you that this is the profit and loss statement. Again, in case you forgot that what report you were running. But then it tells you the time frame, and that is actually somewhat useful to have here because maybe it didn't actually run the report for the time frame that you were trying to run it for. So your profit and loss, otherwise known as your income statement, the basics of it is your income minus cost of goods sold minus overhead expenses gets you down to your net income. So in here, as you can see, the top portion of this report is the income statement. Now, this company has it broken down by different types of services that they offer. They offer design services, they offer landscaping services, and then they bill out their labor. This one's kind of interesting. They've got pest control. Anyway, so all of those different types of services total up to income of just shy of $16,000 for the first half of the year. And that, having that number isn't going to tell us a whole lot right now, but it's good to see that that's the total income. Again, under your total income, you have your cost of goods sold. Cost of goods sold are anything that you purchase, any expenses that you have that are specific to a particular job or customer. these are expenses that you wouldn't have if you didn't have income coming in from that particular project. So cost of goods sold could be physical, tangible things that you're buying. It could be labor that you're paying. It could be sales commissions that you're paying. If you've got somebody out there who's selling your jobs and you pay them based on how much of a contract that they land. Those things would be cost of goods sold. In this case, they have cost of goods sold and they have subcontracted labor. Subcontracted labor is labor that they paid somebody outside of the company to go in and do the job for them. And again, because it's specific to a job, falls under cost of goods sold. So you've got your total cost of goods sold, and then below that you have your gross profit. Now, gross profit is your total income minus your cost of goods sold. Sorry, guys. Accounting is a lot of math, in case you didn't know. So this report is going to be a lot of adding and subtracting, adding and subtracting. So your gross profit, though, tells you how much money you have left over after cost of goods sold to cover your overhead expenses. And your overhead expenses are the things that you would have to pay regardless of whether you're doing work or not. It's things like repairs and maintenance, rent, utilities, insurance, licensing fees. Those things all have to be paid in order for you to do work, but it's not specific to a particular work that you're doing. So they fall under overhead, and in this case, it's just labeled expenses. So you'll see here that they have several different options for categories of expenses, and then you have your total expense line. Below your total expense line is net operating income. Now this is another math equation. It's your gross profit less your total expenses gives you your net operating income. And if you're ever interested, there are a few expenses that happen that are below your net operating income. This net operating income is also referred to as Ebitda, E-B-I-T-D-A. I have another video related to Ebitda. If you want to take a look at that, it's actually a little humorous. But this net operating income tells you what has occurred, the income that you've brought in specific to what's going on in that period. These have other income and other expenses that may show up below your net operating income. In this case, you have interest expense. The reason interest expense is below your net operating income is because the only reason you have that expense is because of something that you did in previous reporting periods. And specifically in this case, they took out debt in a previous year, reporting period, and now they're having to pay the interest on that debt. So anyway, your net operating income less your other expenses, or plus your other income less your other expenses, gives you to your net income, your bottom line, as we sometimes refer to it. Now, if we were running this report on a cash basis, that net income would most likely be what your taxable income is for the period. And because we're running it on an accrual basis, there may be some differences between what is taxable and what's not. That is your overview of reading the P&L. You can see the basic layout. Now I want to talk to you a little bit about comparisons, because that's really where reading the financial reports makes a difference. You can get some information out of your financial reports when you do comparisons. For our purposes, I'm going to display our columns by months, and we're going to do it again on an accrual basis. We're going to run the report. Now, before we even look at this, I would like to say that there's certain things that we know about landscaping services. Typically, a landscaping service is going to be a very cyclical business, meaning that they have periods when they're really busy and periods when they're not so busy. And we would expect the winter months to be not as busy as the summer months. So when we look at this P&L by month, that's how we test these hypotheses. So when we look at this P&L by month, we can see that January and February were relatively the same, not a significant difference. March, we start to see an increase. But then in April, the income really declines significantly. And it bounces back a little bit in May, and then June really skyrockets. I would be interested to find out what happened in April that made it so much lower than the previous months. So that would be one of my first questions. If I was advising this client, I would be trying to figure out why are April and potentially May so much lower than we would expect them to be. We can see trends. We can see, as we're doing these reports, like we can see that, their insurance is about the same amount every month. But then they have this big bill in June. Were they maybe catching up for some months? Did they have an annual payment that came out in June that we need to pay attention to? Those are things that we look at. We look at these trends, and it can give us some information about what's going on in the business as a whole. One thing I really like to look at is their interest expense. When I'm looking at this, I see that it's trending down month over month. Every single month it's getting a little bit less. And what that tells me, without looking at any other information, without knowing anything else about this business, is that the debt that this company has is all term loans. If they had any non-term loan, like recurring debts or credit cards, their interest would be a lot more sporadic. But in this case, it's obvious that they're doing a very good job of paying down the principal that they owe interest on. So that's one of the things that we can find out when we're doing these comparisons, is we can infer information about the company, we can see trends, and then we can also make decisions based on these comparisons, these month over months and year over year. Another thing that I would like to show you is, we'll go back to the total and we'll run this with a previous period comparison. So what this is going to do is it shows, I want to do the dollar change and percent change. So what this shows us with that previous period report is it shows us the current period that we were running the report on, the January through June, and then it shows us the previous 6 months so that we can see that change. And we can see that from July through December, they had total income of $8,700, $8,800. And then in January through June, they basically doubled this dollar change versus percent change. So they've got 80% growth from the previous 6 months. Now, knowing that growth rate is important for the business going forward. As you're making decisions, you can make budgets off of those growth rates. You can make projections off of those growth rates. So knowing these, obviously, as income is growing, your cost of goods sold is probably going to grow roughly the same. In this case, it grew significantly more than that 80%. I'd be interested to find out why their cost of goods sold is going up so much in rate percentage. And overall, their income, they were operating at a loss in the previous 6 months. They're operating at a profit now. Those things are all good indicators to know. And that's one of the big things that we like to look at, is these year over year, quarter over quarter, month over month comparisons, because it tells us a lot about the health of the company. So that said, that is our deep dive into reading the profit and loss. If you have questions, comments, concerns, I'm going to go ahead and stop sharing my screen now. Anyway, so if you have questions, comments, concerns, drop them in the comments below, or my contact information is at the end of this video. I'd be happy to have a chat either over email, over the phone. I'd really appreciate it if you'd like and subscribe. And as always, take care. We'll see you on the next video.